So, hello everyone. This is Tegen Haile, and this is our course International Trade Theory and Policy. So we have almost 14 students. So maybe let's wait for just 1 minute. So today we will be starting our first chapter, Introduction to International Trade. Last week we have discussed about the course syllabus, and there we have talked about the course overview, course description, course introduction, course objectives and goals, the grading system, the topics or the chapters in this course, Introduction to, International Trade Theory and Policy. So today we will start our first chapter, and our first chapter will be about Introduction to International Trade. So as I have mentioned last time, this course is divided into two major categories. So we have the theory part, international trade theory, and the other is international trade policy, right? So up to the midterm exam, and maybe 1 or 2 weeks after the midterm exam, we will be focusing on international trade theory. Then after that, we will be focusing on international trade policy, right? So as I've tried to mention last week, international trade is it deals with international economics and international finance issues because international trade, international economics has gained its existence, or international economics has come to existence because of international trade and international finance. And we have mentioned that in international trade, or when countries trade, they also exchange money. So the exchange of money or money transaction will be dealt with international finance issues, and other goods and services transaction will be dealt with international trade topics. And I also mentioned that this course used to be called international economics. So the point is the focus of this course is on the trade issues mostly. We are not going to talk about the detail in economics models, but we will focus on those issues, economics issues, which are determinant or which are very essential to international trade. Okay. So having said that, so let's talk about the first chapter. First chapter is about introduction to international trade. And in this chapter, we have three main objectives, okay? So the first objective is, in this chapter, we'll learn what is the difference between international trade and domestic trade. Okay, so that's the first objective. So there we will talk about what is international economics or what is international trade about. Okay, so we have to distinguish between international trade and domestic transactions. Okay, and or domestic economic issues. So there are international economics issues and there are domestic economic issues, as we have international trade and domestic trade or domestic transactions. So just to mention one example, when in Korea, for example, when a business in Suwon trades with its partner in Seoul or its partner in Incheon, then we say this is a domestic trade, right? Because these two cities are located, or these two states are within Korea, right? But Korea could also trade with China, Korea could also trade with Africa, Korea could also trade with Europe. So that we call international trade, right? The economics issues is also the same. So we talk about international economics issues when there is international exchange of goods and services, right? And we talk about domestic economic issues because of transaction between states within the same country, right? So we also have tried to mention some points about international trade and domestic trade in our last week's discussion, right? So again, we'll talk about this international and domestic economic issues in this chapter. And we will also distinguish the impact of international trade and domestic trade on the economy of a country, okay? So the other objective is we will talk about some 7 themes that reoccur in international economics. Okay, so last week we have said that in international economics we are going to adopt or use the same economic principles that are commonly used in other branches of economics, right? Because we have said the motive of individuals is the same, right? And the motive of businesses is also the same. So we have mentioned that businesses or firms are in trade because they want to make a profit, unless they are non-profit organizations. So the motive of individuals or firms or businesses to engage in international trade is the same. That's why the economic principles that work for domestic or other branches of economics hold this true for the international economics also, right? So these are the 7 themes that reoccur in international economics and other branches of economics also. These are the gains from trade, one, and patterns of trade is the other, government policies on trade is the other. So these are international trade topics, right? So we'll talk about these 3 international trade topics, and we also talk about 4 international finance topics in this chapter, okay? So we'll talk about balance of payment, exchange rate determination, international policy coordination, and capital markets. So these are the 4 topics in international finance that we'll talk in this chapter. And the 3 are international trade topics. Okay, so in total, we have these 7 themes that reoccur in international economics or international trade. So we will be talking about these terms, okay? And the other is international trade versus finance. So we'll be talking about trade and monetary aspects of international economics. Okay, so we have 3 major objectives. Right? The first one is to distinguish between international and domestic economic issues. The first one is to get familiar with the 7 themes that reoccur in international economics. These 7 themes are the gains from trade, patterns of trade, the effects of government policies. These 3 are international trade topics, and the other 4, balance of payment, exchange rate determination, international policy coordination, and capital markets are the 4 international finance topics. So you have to be familiar with these 7 international economics themes that reoccur in economic issues or in economic studies. And the third one is to distinguish between this trade and monetary aspects of international economics. So as we have said, international trade and international finance are two different things, right? So last week we have said that international trade mainly focuses on transaction of goods and services, while international finance focuses on the exchange of money or monetary exchanges between countries, right? So when there is international trade, there is exchange of money between nations, right? So you have to distinguish between these two. So we have these three main objectives. Okay, so let's proceed. So to our first topic, and I would like to remind you that last week we have also mentioned that this international trade or international economics is not something new. It has been there a long time ago, right? And it became more famous, for example, in the 70s, 58. Okay, and there was a Scottish philosopher who has proposed a model for economics, and after him, after almost 20 years, then I think you all remember the Wealth of Nations book by Adam Smith that was in 1776. So since then economics became a model-oriented subject of discussion, right? But the link between countries has been very much increasing since then. And these days, countries cannot be isolated by themselves. Okay, so the link between countries has been high as compared to the old days. Okay, so the linkage could be through trade of goods and services, or it could be through investment. Okay, but countries are now very much dependent on each other more than as they were before. Okay, so international economics is about how nations interact through trade in goods and services, through the flow of money, and through investment. Okay, so this is what has created a great link between nations: the trade of goods and services, the flow of money, and the investment. Okay, this is the link. And now than ever before, countries are very dependent on each other. Okay, because one country buys goods and services from the other, and the other country might invest on foreign direct investment in the other country. Okay, so they are interlinked. And this interlinkage between countries is determinant of the economic growth of the country, as we have said last week. So being involved in international trade is a determinant factor to the growth and development of a country. Because if Korean investors have, for example, let's say, have a direct foreign investment in China, okay, so this foreign direct investment, when they are profitable in China, because these investors are Koreans, they will invest back their profits, or they get their profit back to Korea, so which will have a significant influence or a significant contribution to the economic growth of Korea, right? So this means if there is something, if there's something negative happened, or if these investments are not doing very well in China, so this indirectly affects the economy of Korea, because these investors are Koreans. Okay, so the money that should have been reimbursed from the profit of the investment in China, if it's not good, or if the profit is getting very low, then that affects the Korean economy, because of the amount of money that is going back to Korea is decreasing, right? So then international economics is about nations who interact with trade and services, flow of money, and investment. Okay? So international economics is an old subject, as I've said, so it has been there a long time ago, but it became very visible in the 18th century, in the 1958 and in 1776 with Adam Smith of his book, The Wealth of Nations. Okay, but it has been there long time ago, maybe before Christ. Okay, 200 BC. Okay, so international economics is an old subject, but continues to grow in importance as countries become tied more to the international economy, right? And because countries are now more dependent on international trade and international economics because of for their growth and development. Okay, so nations are more closely linked with each other than ever before. Okay, and for example, if you take the US exports products or exports goods and services to other countries, but at the same time, US also imports goods and services from other countries. Okay, so US exports and imports as shares of gross domestic product have been on a long-term upward trend until 2008. Okay, then it became down because of the recession in 2008, 2009, right? So international trade has roughly tripled in importance compared to the economy as a whole in the past 50 years. And both exports and imports fell in 2009 in the US because of the recession in 2008, 2009, right? So for example, if you see this graph, you can see that, so the red line shows the number of import to the country. So the x-axis is the year, and the y-axis here is the amount of import-export and percentage of US national income. So you can see that import and export were increasing until 2008 here. Then it falls down, right? And then it revived again in 2010. Okay, so one thing I would like to remind you here is you can see parallel growth between import and export. So I will tell you why it is important to have a balanced import and export. Okay, so for example, if you take the US here on the graph, you can see that the imports are much more higher than the exports, right? Because you can see that the import graph is above the export graph. Okay, so this means there is high import to the US than export. Okay, so there is a huge amount of money invested on imports than US got from exports. Okay, so you can say there is a trade deficit here. Okay, but we will talk about it. So trade deficit is not good for a country, but you can also control this through other means of flow of investment or flow of money to the country. Okay, so I'll tell you one example. If you take most of the foreign direct investments in Europe, they are owned by the US. Okay, so even though US has a trade deficit, that will be compensated with the foreign direct investment that the US has in Europe and other parts of the world. Okay, so here it is negative, but that would be balanced by the foreign direct investment so that US will have a positive trade balance. Okay, so we will talk about these issues. Trade balance could be affected by import and export and also by foreign direct investment. Okay, but I would like to inform you here is that it's better when countries have almost the same amount of imports and exports, not to have a trade surplus or a trade deficit. Okay, so when the export is higher than the import, we say there is a trade surplus. Okay, trade surplus when export is higher than import. So for example, for the last 40-50 years, China and Korea have a trade surplus, which means they export more products and services to other countries than the amount they import to their countries. Okay, so that is good for the economy actually. Okay, so you have heard that the US has been in a trade war between China because China has this trade surplus over the US actually and other countries. Okay, but the case of South Korea is different because South Korean government claimed that it is not an imposed trade surplus, but it is because, I mean, it's not the wish of the Korean government to have a trade surplus over other countries, but it was forced upon them. Okay, but countries blame China because China intentionally creates the trade surplus, and I will tell you how you can intentionally create trade surplus. Okay, one example is you can devaluate your currency. Okay, so when you devalue your currency, your export will grow. We'll talk how that is created. But when the value of your currency is devaluated, so which means goods and services in your country are cheaper for other countries to buy, right? Through that, you increase your exports. So countries blame China for having trade surplus by manipulating the currency value, right? But they don't blame South Korea on that because South Korea claims that this is imposed on South Korea, not because South Korea is does want this trade surplus. Okay, so today we will be talking about like 40 minutes. Then after 40 minutes, I will stop. Then we'll have a 10 minutes break. Then we continue. Right. So let's continue. Then, as I've showed you, this shows trade deficit that the US has. So then, compared to the United States, other countries are even more tied to international trade. Okay, so as I've said, the US can balance its trade deficit because US has higher imports than exports. There is a trade deficit, but US balance this through foreign direct investment and through other means of cash inflow to the country. But compared to the United States, other countries are even more tied to international trade. So which means other countries are even more dependent on international trade. Okay, so so that's the example I given about the trade war between China and the US is because since I mean when Chinese government devaluated its currency, so it's attracting most of the investors to China, right? And the China's export will increase because now the price of goods in China are less expensive as compared to price of goods in the US. Okay, so this will attract more or take away more investors from the US to China. That's why they are having this trade war, right? So their imports and exports as a share of GDP are substantially high. Okay, so the United States, due to the size and diversity, okay, compared to other countries, the US can withstand this because of its size and diversity of resources, okay? And it relies less on international trade than almost any other country in the world, okay? So, because as I've said, the US has foreign direct investment and also other means of gaining more money or bringing more money to the country. So compared to other countries, US relies less on international trade. Okay, so but those countries which are developing now or which are underdeveloped rely high on international trade because they don't have any other means of compensating the trade deficit. Okay, so they always try to balance their import and export with the other nations in the world. Okay, so and now this is the average of exports and importers as percentage of national income in 2011. Okay, so you can see that the US has low exports and imports as percentage of the national income. Canada a little bit higher, Mexico, Germany, South Korea, and Belgium. So they have higher imports and exports percentage of national income as compared to the US. Then let's talk about, so this is now about the difference between international trade and what it means by international trade and international economics. Okay, so I have also explained the difference between international trade and domestic trade, and the issue of international economics and domestic economics also differs, right? So if in the domestic trade, since the two business partners trading are within the same country, so the economic implications are different as compared to international economics when we are having trade between nations. Okay, so we will talk about this introductory chapter is introducing concepts in the chapters that we will be discussing in the future. Okay, so just have the common understanding. Then in second, third, fourth, fifth chapter will be we'll be discussing in detail about these concepts. Okay, so then we have the second objective is to talk about the 7 themes that are reoccurring in international trade. Okay, so the first one is gains from trade. So last week I have explained a little bit about the fact that this international trade is mutually beneficial to both countries involved in international trade. And I have mentioned that if there is a loss, that might be because of the policies or theories that are applied in international trade. It's not the problem of having international trade by itself that brings a loss to the country. Okay, but while implementing these issues, that there are some problems. So we will discuss them here. Okay, so there are gains from trade. So the concept that there are gains from trade is probably the most important insight in international trade and international economics. Okay, so we have also said that international trade is the factor for growth and development for a country these days. Okay, so countries selling goods and services to each other almost always generates mutual benefit. Okay, so when we say mutual benefit, trade benefits both parties involved in the trade. Okay, so if one is importing and the other is exporting, so the country importing and the country exporting both are benefited from the international trade. Okay, so when a buyer and a seller engaged in a voluntary transaction, both can be made better off. Okay, both can mutually benefit. Okay, so the reason is, we tried also to mention a little bit about this. Countries do have their own comparative advantage. Okay, we cannot say Korea should produce everything that Koreans consume. Okay, because it's not possible. So what is possible? It's not possible because of the natural resource, because of the weather, because of several different reasons, right? It's not possible. So what is possible is Korea will produce products, goods and services that Korea is good at, then sell these products or goods and services to other countries. But at the same time, those goods and services that are not produced in the capacity of Korea should be bought from other countries. So this is import, right? And Korea should export those on which Korea is good at, right? So for example, the Norwegian consumers import orange that they would have a hard time producing, okay? So it might be because of the environment, because of the soil, because of, not all fruits are produced in Korea, right? Maybe the weather is not good for them, okay? So Korea has to import those fruits that are not produced in Korea and also export fruits that are not produced in the US, for example, or in the Philippines or in Vietnam, okay? So this trade benefits both the buyer and the seller, okay? So I will stop here because the maximum time I'm allowed to stay is 40 minutes. So we'll continue with our second session just after 10 minutes, okay? So I will close this, this page, then I will send you the meeting ID and password again in 10 minutes, then have a break for 10 minutes, okay? Thank you, then see you after 10 minutes.